September 15th, 2008, at about 1:45 in the morning, on the 31st floor of Lehman Brothers headquarters above Times Square in Manhattan, Richard Fuld, the chief executive, stared out over the lights of the city, while television crews gathered on the streets below and reporters prepared to broadcast the end of a 158-year-old institution that had once survived the Civil War, 2 world wars, and the Great Depression, but would not survive this night. Within hours, Lehman Brothers would enter the largest corporate bankruptcy in the history of the United States, with roughly $639 billion in reported assets, about $619 billion in obligations, and around 25,000 employees facing the loss of their livelihoods, a collapse that would freeze credit markets, trigger a cascade of stock market sell-offs, push banks worldwide toward the edge, and light the fuse of the Great Recession, the worst economic crisis since the 1930s. Yet this catastrophe was not an accident or a streak of bad luck. It was the logical outcome of a financial system built to disguise risk, reward leverage, and shift the fallout from the executives who made the decisions onto everyone else. And instead of shrinking after Lehman fell, that system was patched together and allowed to grow even bigger. Long before its name became shorthand for disaster, Lehman Brothers was a symbol of Wall Street respectability. Founded in 1850 in Montgomery, Alabama, by 3 German immigrant brothers named Henry, Emmanuel, and Mayer Lehman, the firm began as a cotton trading operation dealing with southern plantations and northern mills, then moved to New York after the Civil War and evolved into an investment bank that, over the next century and a half, helped finance iconic American companies, underwrote stock offerings for retailers like Macy's and Woolworths, and rode the wave of technology initial public offerings in the 1990s. By the year 2000, Lehman Brothers ranked as the 4th largest investment bank in the country, behind Goldman Sachs, Morgan Stanley, and Merrill Lynch, employing roughly 25,000 people across about 40 countries and overseeing client assets measured in the trillions of dollars. In the late 1990s, most of Lehman's revenue came from traditional investment banking activities, such as underwriting, advising on mergers and acquisitions, and managing wealthy clients' portfolios, work that produced solid but unspectacular returns. Until the dot-com bubble burst around the year 2000, stock markets plunged, corporate deal-making dried up, and Lehman's leadership went hunting for a new profit engine. They found it in housing. Starting around 2000, Lehman pivoted aggressively into mortgages and mortgage-backed securities, not just financing mortgages, but buying up mortgage originators, bundling loans into securities, and trading those securities for enormous fees. By 2004, the firm had become one of the heavyweight players in the mortgage market, and the profits were eye-popping, with net income of about $3.3 billion in 2005 and roughly $4 billion in 2006, while Richard Fuld collected more than $40 million a year and joined the ranks of the highest-paid executives on Wall Street. But those earnings depended not on safe conventional loans, but on increasingly risky subprime mortgages. After the dot-com bust, the Federal Reserve under Alan Greenspan slashed interest rates, pushing them down to about 1% by 2003, the lowest level in more than 4.5 decades, making borrowing extraordinarily cheap, which pushed more buyers into housing, drove up home prices, allowed existing homeowners to borrow against inflated equity, and created an illusion of endless prosperity. Yet as banks ran out of borrowers with strong credit histories, so-called prime borrowers, they turned to people with poor credit scores, patchy employment, minimal savings, or dubious documentation, the subprime borrowers who would never have qualified under stricter standards. The key reason lenders were willing to write these risky loans was that they no longer intended to keep them. A mortgage company might extend a $300,000 loan to a borrower barely able to meet the payment schedule, then immediately sell that mortgage to an investment bank like Lehman, which would combine thousands of such loans into a mortgage-backed security to be sliced up and sold to investors, such as pension funds, insurance companies, and foreign institutions searching for yield. The originator made money on upfront fees. Lehman earned big profits on structuring and distribution, and investors thought they were buying safe, high-return products anchored in United States real estate, all while rating agencies like Moody's and Standard & Poor's stamped many of these securities with their highest AAA ratings, despite the fact that the underlying loans included adjustable-rate mortgages that would reset to unaffordable payments, zero-down payment loans, liar loans with fabricated income, and so-called ninja loans, no income, no job, no assets. By 2006, roughly 1/5 of all new mortgages in the United States were subprime, with around $600 billion of such loans written in that year alone, and Lehman Brothers was deeply involved. On top of that, Lehman and its peers took the lower, riskier tranches of these mortgage-backed securities and repackaged them into collateralized debt obligations, CDOs, that turned slices of the weakest loans into new complex products that, amazingly, often received top-tier credit ratings for their senior tranches, a kind of financial alchemy that turned trash into supposed gold through sheer complexity. And global investors, trusting the ratings, bought them in huge quantities. By 2007, Lehman's balance sheet carried more than $85 billion of mortgage-backed securities and CDOs, essentially gigantic bets that home prices would keep rising and that subprime borrowers would keep paying. Instead, home prices peaked around the middle of 2006 and then began to decline nationwide for the first time in modern American history. Local real estate downturns had happened before, but a broad national slide had not, and as adjustable rate mortgages reset to higher payments in early 2007, default rates among subprime borrowers soared. Red lights began blinking across the financial system. In February 2007, HSBC revealed huge losses tied to subprime loans. In April, New Century Financial, a leading subprime lender, went bankrupt. 2 hedge funds at Bear Stearns collapsed that summer under the weight of toxic mortgage securities. And in August 2007, the French bank BNP Paribas froze redemptions in 3 funds holding mortgage-related assets because it could not determine their value, signaling that the market for many mortgage-backed securities had seized up. Banks grew wary of lending to each other because no one knew who was holding how much bad paper, forcing the Federal Reserve to inject emergency liquidity. Publicly, however, Lehman reported record profits in 2007, about $4.2 billion, and Richard Fuld continued to insist that the subprime problem was contained, just a localized issue. Privately, executives knew that the firm's exposure to real estate and complex mortgage products was enormous. The chief risk officer, Madeline Antoncich, warned senior management late in 2007 that exposure should be sharply reduced. Instead, she was sidelined from her role early in 2008. Then came the collapse of Bear Stearns. By March 14, 2008, Bear Stearns, the 5th largest investment bank, was on the edge of insolvency after its short-term lenders in the repurchase, or repo, market refused to roll over billions of dollars in funding. The firm's stock, which had traded above $170 a share the previous year and around $30 shortly before the crisis point, was on the verge of total wipeout. The Federal Reserve under Ben Bernanke and the Treasury Department under Henry Paulson decided they could not allow Bear's uncontrolled failure, fearing a systemic panic, so they arranged a rescue in which J.P. Morgan Chase, with roughly $30 billion of Federal Reserve backstop, bought Bear Stearns for $2 a share, a price later raised to $10. Watching from Lehman's Tower, Richard Fuld drew a powerful conclusion. Large Wall Street firms were too big to fail, and if Bear Stearns could be saved, surely Lehman would receive similar treatment if trouble came. He was reading the wrong lesson. The Bear bailout provoked public and political outrage over moral hazard, the idea that rescuing reckless institutions encourages more recklessness, and Henry Paulson, a former Goldman Sachs chief now serving as Treasury Secretary in the final months of a Republican administration, resolved not to spend taxpayer money rescuing another major investment bank. Lehman had roughly half a year after Bear Stearns to raise new capital, shed risky assets, shrink its balance sheet, and perhaps find a buyer. It did none of that effectively. In June 2008, Lehman posted a loss of about $2.8 billion for the second quarter and wrote down roughly $5.6 billion in mortgage-related holdings. Its stock dropped sharply, and potential investors, including sovereign wealth funds and private equity firms, walked away after peering into Lehman's books and concluding that the losses ran deeper than the firm admitted. Talks with Korea Development Bank went nowhere. By early September, Lehman was running out of options. On paper, it still held about $639 billion in assets, but the firm's tangible equity was only about $25 billion, implying a leverage ratio of roughly 25 to 1, meaning that a small decline in the value of its holdings could wipe out the firm completely. Its share price, which had been above $60 at the start of the year, sank to around $14. Then, on September 9th, Lehman announced a third-quarter loss of around $3.9 billion. The stock collapsed by about 45% in a single session to roughly $7.79, and credit rating agencies threatened downgrades that would trigger collateral calls Lehman could not meet. Fuld scrambled to find a buyer. Bank of America showed interest, as did Barclays in the United Kingdom, but both made clear they needed government guarantees to absorb Lehman's toxic real estate portfolio, just as J.P. Morgan had received support when absorbing Bear Stearns. On Friday, September 12, 2008, Henry Paulson summoned the heads of major Wall Street firms leaders from J.P. Morgan, Goldman Sachs, Morgan Stanley, Citigroup, Merrill Lynch, and others into a crisis meeting at the Federal Reserve Bank of New York and delivered a blunt message. The United States government would provide no public funds to rescue Lehman Brothers. If Lehman was to be saved, its peers would have to bear the cost. Bank of America examined the numbers and instead chose to acquire Merrill Lynch, which was also wobbling. Barclays remained the only candidate, but British regulators insisted on a formal United States guarantee against Lehman's losses. Paulson refused, and by Saturday evening the Barclays option was dead. With no buyer, dwindling cash, and lenders backing away, Lehman had no path forward. On Sunday, September 14th, its board voted to file for Chapter 11 protection, and in the very early hours of Monday, September 15th, the bankruptcy papers hit the court, closing the book on 1.5 centuries of history. Lehman's fall detonated a shockwave. The firm's bankruptcy, involving roughly $639 billion in assets and $619 billion in liabilities, was not only massive in size but entangled in nearly every corner of the financial system. Lehman was party to more than 900,000 derivative contracts with counterparties worldwide, and the moment the firm failed, nobody knew who owed what to whom. On the day of the filing, the Dow Jones Industrial Average plunged more than 504 points, its largest one-day point drop since the attacks of September 11, 2001. By week's end, it had lost over 1,000 points. More dangerously, credit markets seized almost entirely. Banks distrusted each other and hoarded cash. The commercial paper market short-term funding that corporations relied on to pay employees and suppliers froze. AIG, the largest insurer in the United States, reeled as credit default swaps it had sold on mortgage securities suddenly generated huge losses. One day after Lehman's bankruptcy, the Federal Reserve extended roughly $85 billion to keep AIG from toppling. Money market funds, which were marketed as ultra-safe equivalents of cash, began breaking the buck, with the Reserve Primary Fund holding about $785 million of Lehman debt, telling investors it could only return 97 cents for each dollar invested. Within days, panicked investors pulled more than $300 billion from such funds. On September 18th, Henry Paulson and Ben Bernanke went to Congress and asked for authorization to deploy about $700 billion to stabilize the financial system, warning that without massive intervention, the entire credit structure could collapse, ATMs might stop dispensing cash, businesses could fail en masse, and the economy could slide into a depression. Congress initially said no on September 29th, and markets responded with a one-day plunge of about 737 points in the Dow, the largest point decline on record at that time. Lawmakers quickly reversed course and passed the Troubled Asset Relief Program in early October. The crisis radiated overseas. Iceland's banking sector imploded. European lenders with exposure to Lehman and United States mortgage securities suffered heavy damage. Emerging market countries from Brazil to Russia experienced capital flight, and world trade contracted sharply. In the United States alone, about 8.7 million jobs disappeared. The unemployment rate climbed to roughly 10%. Households lost about $16 trillion in wealth. Home prices fell around 30% nationally and roughly 50% in some overheated regions. And it took until about 2014 for employment to return to pre-crisis levels. Once the immediate panic eased, the search for culprits began. Richard Fuld testified before Congress in October 2008, grilled by lawmakers like Henry Waxman about why he had taken more than $480 million in compensation between 2000 and 2008, while shareholders and employees were wiped out. Fuld blamed short sellers for attacking Lehman stock, blamed officials for refusing to rescue his firm after saving Bear Stearns and later AIG, and blamed the media for fueling fear. But he never conceded that Lehman's business model relied on excessive leverage, opaque real estate bets, and accounting maneuvers that obscured losses, or that internal warnings about risk had been dismissed. Henry Paulson also faced intense criticism for saving Bear Stearns and AIG while allowing Lehman to fail. He argued that he lacked legal authority to bail out Lehman without congressional approval, though many noted that he had found a way to support AIG almost immediately afterward. In reality, he had wanted to show that bailouts were not automatic, and chose Lehman as the point to draw that line, badly underestimating how deeply woven Lehman was into the global system. Credit rating agencies bore responsibility for assigning top ratings to securities filled with subprime loans while being paid by the very banks whose products they evaluated. A clear conflict of interest. Regulators such as the Securities and Exchange Commission, the Federal Reserve, and the Office of the Comptroller of the Currency all missed, ignored, or failed to act on mounting evidence of dangerous risk-taking. And Lehman was hardly alone. Major firms including Citigroup, Merrill Lynch, Bear Stearns, Wachovia, Washington Mutual, and others all chased enormous profits by loading their balance sheets with subprime mortgages and exotic derivatives, confident that if things went wrong, the downside would be borne by shareholders, taxpayers, and the broader public, not by the executives harvesting bonuses. In the months after Lehman's failure, Washington Mutual, then the largest savings and loan in the country, collapsed and was sold to J.P. Morgan. Wachovia nearly failed and was acquired by Wells Fargo. Merrill Lynch, acquired by Bank of America to avoid its own collapse, went on to reveal around $27 billion in losses in the final quarter of 2008, forcing Bank of America to seek additional government support. Goldman Sachs and Morgan Stanley, the last two independent investment banks, converted into bank holding companies so they could tap Federal Reserve emergency lending, effectively ending the classic Wall Street investment bank model. In 2010, Congress enacted the Dodd-Frank Act, the most sweeping financial regulatory overhaul since the 1930s, creating new oversight bodies, raising capital requirements for large banks, and attempting to design procedures so that failing institutions could be wound down without another Lehman-style disaster. Yet critics argued that the law was too weak and too complicated, and in the years since, banks have spent heavily on lobbying to roll back or soften key provisions. Crucially, almost no senior executive went to prison, not Richard Fuld, not the chiefs of Bear Stearns, Merrill Lynch, Citigroup, or AIG. Some firms paid large fines that ultimately came out of shareholders' pockets, but personal accountability at the top was minimal. Meanwhile, the surviving banks became even larger. J.P. Morgan absorbed Bear Stearns and Washington Mutual. Bank of America absorbed Merrill Lynch. Wells Fargo absorbed Wachovia. And the big four J.P. Morgan Chase, Bank of America, Wells Fargo, and Citigroup came to control well over $10 trillion in assets, roughly 40% of all United States banking assets, making the too-big-to-fail problem worse, not better. The lesson that should have been drawn from Lehman Brothers is that no private institution should be allowed to become so large and so entangled with the rest of the system that its failure threatens the global economy. Instead, the lesson Wall Street effectively absorbed was that if a firm is big enough and plugged in enough, the government will ultimately rescue it to avoid disaster, so the only real danger is being the first one allowed to fall. Lehman was that sacrificial example, permitted to fail to make a point about moral hazard. And then, within days, the government spent about $700 billion plus trillions more in central bank support to stabilize everyone else. 1.5 centuries of history, $639 billion in assets, around 25,000 jobs, and untold savings and pensions were destroyed in a single chaotic week because executives chased profits with extreme leverage. Regulators looked away. Rating agencies misrepresented risk, and politicians waited to act until the system was already aflame. Lehman Brothers did not collapse because of a random shock. It collapsed because of a financial architecture that normalized greed, obscured leverage, and embedded systemic corruption, and that architecture still exists. The banks are larger. Complex financial instruments remain central. Leverage has crept back. Real estate in many places is stretched, and commercial property is staring down roughly $1.5 trillion in loans maturing through 2026, even as post-crisis safeguards are weakened. The next major crisis could emerge from property, from corporate debt, from sovereign debt, or from some corner nobody is watching, but it will emerge for the same reason. The system was not truly repaired, only flooded with central bank money and government guarantees. When that moment comes, the unresolved question from Lehman's ghost will surface again. Will authorities once more sacrifice one institution to make a symbolic stand? Or will they step in early and repeat an even larger round of rescues for a system that never really changed,